The market just did something it has done only 3 times in the last 40 years. And every single time it happened, the investors who panicked lost everything, while the ones who understood what was actually happening made fortunes. Gold dropped, silver crashed, headlines are screaming. But there is one thing, one specific detail that nobody is talking about, and it changes everything. Welcome to John Analyst, the channel where serious minds meet serious money. Now, before we go any further, if you have been watching this channel, even once, then you already know. This is not just another video. This is the kind of analysis that decisions are made on. So do something for me. Hit that subscribe button. Think of it this way. If a trusted old advisor, someone you have known for years, told you, subscribe just once, trust me, would you say no? Now, tell me in the comments, where in the world are you watching this from? Because this conversation is just getting started. January 29th, gold was trading above $4,500. Silver had just touched its highest levels in years. Investors across the globe were watching the numbers climb. Confidence was high, momentum was real. And then, in just 48 hours, everything changed. The prices dropped hard. Gold pulled back sharply. Silver fell even faster. Financial headlines immediately began publishing the same word: crash. And for millions of investors watching their screens, that word felt accurate. Because when money is moving down that fast, the human mind does not calculate. It reacts. It fears. And fear is the single most dangerous emotion a decision maker can carry into a market. But here is what those headlines did not tell the story. On Saturday, January 31st, a careful analysis of what actually happened during those 2 days reveals something that most retail investors completely missed, something that institutional traders understood from the very first minute of the sell-off. The crash was not what it appeared to be. It was a mechanism, a predictable, calendar-driven event. And once the mechanism is understood, the entire narrative changes. To understand why, one must first go back to the days before the sell-off began. In the final stretch of January trading, gold and silver were behaving exactly the way they behave when serious capital enters the market. Big price movements, heavy volume, strong momentum. Traders were buying aggressively, but not all of those traders were buying with the same intention. Among the buyers, there were 2 very different groups. The first group consisted of long-term strategic investors. These were the business professionals, the wealth builders, the individuals who understood that precious metals serve as a hedge against economic uncertainty. They were not watching daily price movements with anxiety. They were building positions with patience and precision. The second group was entirely different. These were momentum traders, speculators who entered the market not because they believed in the long-term value of gold or silver, but because the price was moving upward. And where price moves up, profit follows, at least temporarily. The second group is critical to understand because this group does not think in terms of weeks or months. They think in terms of hours, minutes sometimes. When the market moves in their direction, they feel confident. When it pauses, even for a single day, they begin to feel uncomfortable. And when it pulls back, even slightly, their only thought becomes one single question: can I still lock in a profit before this gets worse? And the answer to that question drove what happened next. By the time January 29th arrived, the momentum crowd had grown significantly. The rapid price increases had attracted hundreds of millions in speculative capital. These were not investors. These were traders riding a wave, and waves, by their very nature, must eventually pull back. The market knew this. Institutional desks knew this, but the momentum crowd did not. Or if they did know, they chose to ignore it. Because as long as the price kept climbing, the profits kept growing. And human beings, no matter how experienced they believe themselves to be, will always find it difficult to walk away. From a rising number on their screen, this is not a character flaw. This is simply how markets work. The sell-off that began on January 29th was not driven by any new economic data. No government report had changed. No central bank had shifted policy. No geopolitical event had triggered panic. What happened was far simpler and far more predictable. The momentum crowd began to exit, not all at once, but in waves. And each wave of selling created the appearance of deeper decline, which caused the next wave of sellers to move even faster. Within hours, what had been a modest pause in the market transformed into what headlines would call a crash. But for those who understood what was actually happening beneath the surface, this was not a crash at all. This was profit-taking, mechanical, predictable, and most importantly, temporary. The real question, the The question that would determine whether fortunes would be made or lost in the weeks ahead was not whether the sell-off was real. The real question was, what happens next? And to answer that question, one must understand something about the calendar, something about delivery season, something that changes everything. There is a room deep inside the headquarters of one of the largest futures exchanges in the world where a clock has been running for months. Not a clock that measures hours or minutes, a clock that measures something far more dangerous, a deadline. And on January 29th, the day the sell-off began, that clock did not stop. It moved closer. Now, most investors watching gold and silver drop on their phone screens that evening. They did not know about this clock. They did not know about the room. They did not know about the deadline. All they saw was a number falling and a feeling in their chest that whispered one word: sell. But the institutions, the trading desks operating inside glass towers in Manhattan and the City of London, they knew exactly what that clock meant. And they were acting on it. Because what was about to arrive was not a market event driven by emotion. It was a calendar event, mechanical, structural, and completely unavoidable. It is called delivery season, and understanding it changes everything about what happened during those 48 hours. To understand delivery season, one must first understand what a futures contract actually is. A futures contract is not gold. It is not silver. It is a piece of paper, a legal promise, an agreement between two parties that says, on a specific date, at a specific price, one party will deliver the metal and the other party will pay for it. These contracts trade every single day on an exchange called COMEX, the commodity exchange in New York. Billions of dollars change hands there every 24 hours. But here's the critical detail that most retail investors never learn. Less than 2% of these contracts ever result in actual physical delivery. Less than 2%. That means 98 out of every 100 contracts are closed before the deadline arrives. Traders buy them, traders sell them, profits are made, losses are absorbed, and the metal itself never moves. But every few months, something changes. The front month contract, the contract closest to its expiration date, enters what is called the delivery window. And when that happens, the rules of the game shift entirely. Traders who are holding those contracts must now make a decision. They can close their position before the deadline, exit the trade, take whatever profit or loss exists, and walk away. Or they can hold and accept that they will either deliver physical metal or take physical delivery of it. For most speculators, the momentum traders, the short-term profit seekers, holding through delivery season makes no sense. They do not want physical gold sitting in a vault somewhere. They want dollars. They want profit. They want liquidity. So they exit. They sell their contracts before the deadline hits. And this selling, this mechanical, calendar-driven, completely predictable selling is exactly what began accumulating in the final days of January. But here is where the story becomes genuinely dangerous. Because delivery season does not only affect the traders who are exiting, it affects everyone. When large positions begin unwinding ahead of the deadline, the volume of selling increases. The price begins to move downward. Other traders see the price dropping and begin to wonder, is something wrong? Is this a sign of weakness? Should I be worried? And some of them begin selling too, not because the fundamentals have changed, not because the long-term outlook has shifted, but because they see other people selling. And in markets, fear spreads faster than information ever could. This is the trap, the delivery season trap. It is not a conspiracy. It is not manipulation in the traditional sense. It is simply what happens when a predictable structural event meets a crowd of investors who do not understand why it is happening. The institutions understood. They had seen this pattern dozens of times. They knew that delivery season selling was temporary. They knew that once the front month contracts expired, once the mechanical pressure released, the market would resume where it left off before the deadline arrived. But the momentum crowd, the speculators, the investors watching headlines and feeling that punch in the stomach, they did not know this, and their panic was about to create something that institutional desks had been waiting for, an opportunity, one that only becomes visible to those who understand not just what the market is doing, but why. And that opportunity requires understanding one more thing, something about positioning, something about traps, something that will reveal exactly who benefits when prices fall this way. There's a story that no financial newspaper will ever print, not because it is not true, but because the moment it becomes widely understood, the advantage disappears. It is the story of how money actually moves, not the way textbooks explain it, not the way television analysts describe it, but the way it truly operates, behind closed doors, in trading rooms where screens glow blue at 3 a.m, where decisions worth hundreds of millions are made in silence. And it begins with a single question, one question that every institutional desk asks before a single dollar is placed. Who is trapped? This is not a metaphor. This is not an expression. In the language of professional markets, trapping is a deliberate strategy, a calculated sequence of events designed to force other participants into positions where they have no choice but to act against their own interest. And on January 29th, the momentum crowd, the same crowd that had been buying gold and silver for weeks, became the trapped. To understand how this works, one must forget everything that financial media has ever taught about how prices move. Most investors believe prices move because of news. A government report changes. A central bank makes an announcement. A geopolitical crisis emerges. And the market reacts. But this is only partially true. In reality, prices move on positioning, on who holds what, on where the pain thresholds are, on how much pressure is needed to force the weakest hands to surrender. Think of it this way. Imagine a poker table. And at the table sit two types of players. The first type plays with patience. They have deep pockets. They can sit for hours. They do not bluff easily. And they are watching every other player with absolute precision. The second type plays with urgency. They need to win quickly. They cannot afford to lose. And they reveal their nervousness in every single move they make. The first type of player does not win by having better cards. They win by reading the second type, by understanding exactly how much pressure it takes to make them fold. And then applying exactly that pressure. At exactly the right moment. This is what happened in precious metals on January 29th. The institutional desks, the first type of player, had been watching the momentum crowd for weeks. They saw the volume increasing. They saw the leverage building. They watched as speculative capital flooded into gold and silver contracts. And they calculated, precisely, how much selling pressure would be needed to trigger a wave of panic exits. The delivery season mechanics, the calendar-driven unwinding that Part 2 described, that was not the cause of the sell-off. It was the permission. It gave institutional desks a legitimate reason for prices to pull back, a reason that would appear natural, a reason that headlines would explain as normal market behavior. And underneath that legitimate cover, the positioning game began. When the first wave of momentum traders exited, prices dropped. When prices dropped, other traders saw the decline and began questioning their own positions. Some held, but many did not. They sold, and each wave of selling created the conditions for the next wave. This is called cascading liquidation, and it is one of the most powerful forces in any financial market. But here is where the story takes an unexpected turn. Because while the momentum crowd was selling, and while retail investors were watching their screens with that feeling of dread, while headlines were using the word crash, something else was happening. Something that most people watching those falling numbers could not see. Institutional desks were not just sitting back and watching the sell-off unfold. They were buying, quietly, systematically, through channels that never appear on public trading data, physical metal, not paper contracts, not futures, actual gold, actual silver. Moving from vaults into private hands, and the price at which they were buying was the price that the panic had created, the exact price that fear had manufactured. This is the oldest pattern in market history. It happened in the late 1980s, when gold spent an entire decade consolidating between $200 and $400. Retail investors called it dead. They called it boring. They moved their money into stocks, into technology, into anything that was moving upward. But during that entire decade, institutional buyers were accumulating, quietly, patiently, building positions that the public never saw. And when gold finally broke out of that decade-long range, in the early 2000s, it did not move gradually. It exploded from $400 to $1,900 in less than 10 years. And the investors who had sold during the boring consolidation period, who had called it dead, they missed everything. The current pattern is identical. The sell-off of January 29th was not the end of the move higher. It was the moment when the market separated those who understood what was happening from those who did not. And the next leg, the leg that will make everything before it look like preparation, is already being built, quietly, behind the headlines, in the space between fear and opportunity, where serious money has always lived. There is a moment in every market cycle where the story changes, not gradually, not with warning signs that everyone can see, but in a single breath, a single shift, where those who understood what was happening and those who did not are separated forever. January 29th, 2026. Was that moment? And what happens next? will determine which side of that line each observer stands on. But before the final assessment is delivered, one thing must be stated clearly. Honestly, without comfort, without false reassurance, the sell-off was real. The pain was real. The fear was real. Every single investor who watched their positions shrink during those 48 hours felt something genuine, that discomfort, that instinct to protect what remains. It is not weakness. It is human. But here is what separates a strategic decision maker from someone who simply reacts. The ability to ask one question when the emotion is loudest. Has anything actually changed? Not the price, not the number on the screen, not the headline on the news. Has anything fundamental changed? And the answer is no, nothing changed. The supply deficit in precious metals did not disappear on January 29th. 5 consecutive years of demand exceeding production. That mathematical reality remained exactly where it was before the first sell order hit. The institutional accumulation that was happening in physical markets did not stop. It accelerated. The de-dollarization trend, nations reducing their dependence on the United States dollar, central banks buying gold at record pace. That structural shift did not reverse because silver dropped for 48 hours. The delivery season mechanics that triggered the sell-off, they were temporary by definition. Front-month contracts expire, the mechanical pressure releases, and the market resumes the conversation it was having before the calendar interrupted. So the thesis, the long-term thesis that gold and silver are moving higher, remains intact, completely intact. But here is where serious business thinking must enter the picture, because understanding that the thesis is intact is not enough. The question that matters, the question that will separate those who build wealth from those who simply watch others do it, is not whether the thesis is correct. It is whether one is positioned to benefit when the thesis proves itself. And this is where most investors fail. They understand the direction. They believe in the trend. They can explain why gold and silver will move higher. But when the price drops, when fear arrives at their door, they do nothing. Or worse, they sell. Surrendering their position at exactly the moment when holding it matters most. Think about what the institutions did during January 29th, while retail investors were panicking. While headlines were screaming crash, institutional desks were not watching. They were buying physical metal at prices that fear had manufactured. This is not speculation. This is the observable pattern that has repeated itself in every major precious metal cycle in recorded history. The 1980s consolidation, the 2001 to 2011 bull market, the 2020 pandemic crash and recovery, every single time, the pattern was identical. Price drops, fear spreads, weak hands exit, strong hands accumulate, and then the next leg begins, quietly, without announcement, without permission from those who sold at the bottom. Now, for the serious business professional, the entrepreneur, the decision maker who has spent decades building something real, the strategic response is not complicated, but it requires something that markets constantly test: discipline. Physical metal that was purchased before January 29th still exists, still holds the same weight, still represents the same value. The crash did not reach into a vault and remove a single ounce. A number on a screen changed, but the metal did not. And 6 months from now, when the next leg higher begins, when gold breaks through levels that analysts today call impossible, when silver moves toward prices that current headlines dismiss, the only investors who will benefit are those who were still holding when the fear was loudest, when every instinct said sell, when the headlines said crash. They held, and that simple act, that single decision to remain, while everyone around them was running, will be the difference between those who watched the wealth transfer happen and those who were part of it. The market does not care about comfort. It does not reward those who wait for certainty. It rewards those who understand that certainty never arrives before the opportunity disappears. January 29th was not a warning. It was an invitation, and invitations like this one do not come twice.